Hey guys, how's it going? Today I'd like to talk about MGM Resorts International, ticker symbol MGM, and I recently purchased this the end of last week, and I think this is a pretty good value play considering all the things that are going on in the business, and I just want to talk about it a little bit and why this I think this will beat the market over the next couple of years. So first of all, if you don't know, MGM, they have some resorts and they also have the casinos. And I personally love those. Love the casinos. I've been to a couple of them in Vegas, in different areas. And you can see that they have about 18 properties within the United States and in Macau. And there's also an integrated resort in Japan that's coming up. And they also have the Bet MGM. So if you do anything, you bet on UFC or anything like that, they do have the Bet MGM app, which is competing with DraftKings and all those other online companies. And so that's really their main business. And I think it's really incredible just because of the fact that they're owning these different brands. For example, the Bet MGM, they have 50% ownership of that. And the Chinese MGM China, they have a majority ownership of that, 56%. So you have almost 20 properties, and they're doing pretty good, as I'll show you in a little bit. So one of the interesting things about MGM is that they're doing some massive buybacks. So in just the first quarter, they did $500 million in share purchases. And I'll show you their balance sheet in a bit, but this is really impressive. I mean, consider the fact that this business is like the enterprise value of it is maybe like the market cap is like 11 billion. Enterprise value is maybe like 13, 14 billion. But so this is really good. I mean, 500 million is you're talking like 4% of the float in just one quarter. And if you can look from COVID 2020 to 2024, they've reduced their shares by like almost 40%. So that's massive EPS growth, and they're returning a lot of value to shareholders. If you look at some of the outlooks for 2024, they have 400 to 460 million in corporate expenses. If you exclude XVC, they have some capex, which obviously this is going to be a capital intensive business just because they have a lot of tangible assets, and they do have some senior notes that they have to pay, but they're spread out pretty easily, and also they have some lease liabilities, which I'll talk about in a sec. So 3.3 long-term debt, and then also 3 billion in debt in China. But this is really good because I'm going to show you a little bit, but the China business is growing super fast. Okay, so the balance sheet is very clean. I'm going to go over that in a bit, but if we look at just the second quarter, revenues of 4.3 billion, adjusted EBITDA from the Chinese property, which they own 56% of, increases 40% year over year. And part of the reason why I really like this business is that their China business is just exploding. And as you guys may or may not know, travel in China has picked up again. It took them a while to get back to their new normal after COVID, just because I think they were one of the last ones to drop the restrictions. But they've basically returned to like post-Lunar New Year, vacation travel. So they have tons of people just coming in the Macau casino. They're doing a lot of events. The rooms are pretty expensive, so they're making decent margins on those, and the China business is just really doing exceptional. So net cash flow for the 6 months was about $1 billion, and I think free cash flow was about half of that, 600 million. So that's really impressive stuff, and we have a adjusted EPS of 0.86 compared to 0.59. In terms of the balance sheet, very solid balance sheet considering that, casinos do carry a lot of debt just because of the nature of the business, the buildings and all the costs associated with it. You have about $3.5 billion of straight up cash. If you take the 2.4, add it with 1. And in terms of long-term debt, you have about 6.2 billion, which is really solid for, how casinos are. If you look at some other casinos, they have a lot more debt. And considering the fact that they're going to do about 1.2 billion in free cash flow and probably a little more in the next year. Nothing to really worry about, in my opinion, over here. Other than that, we can see that they're, like I was mentioning before, the MGM China business is growing very fast. If you take a look, 740 to 1 million in the last 3 months compared to last year. And the Las Vegas operation is growing as well. we did have the Formula One stuff, but it's up single digits. It's almost flat, and that's fine. I mean, as long as we're not regressing, we have all these other aspects of the business that are really good. Okay, so we do have some stock-based compensation, which is pretty darn low, considering the free cash flow and stuff. So I really like that. Just because most of their employees aren't going to be eligible for the stock-based compensation. So that I already showed you. And I just want to talk about some of the notes they have here. So until 2036, they'll have about $6.2 billion of notes due. So, I mean, if you take that, that's 11 years from now. Obviously, these are due at different times, but you can see that's like $500 million if you annualize that to 2036. And given their free cash flow, this is not a problem at all. There's going to be no problem meeting the 6.2 billion over from 2024 as the first one all the way to 2036. So super solid. If we look at some of the metrics over here, we can see that revenue. Is just going to go over here, analyst estimates, and we can take a look at their revenue projection. Obviously, we did see during COVID. Personally, I used to go to Caesars a lot. I mean, they didn't even really let anyone in the building apart from specific events. So obviously, their revenue was cut in over than a half. But we see it's stabilizing now. 2022 to 23, there was a big, jump. But the estimates for the end of fiscal year 2024 are, single-digit growth, mid-single digits, so like 6-7%. So not bad at all. And the analysts are estimating low single digits. That's probably like 2 or 3% growth. Now, if we look at the free cash flow, we can see that it's hovering around 1 to 1.2 billion for the last little bit. But if we see what the analysts are expecting, we do expect that next year, because of some stronger China results, we'll have $1.4 billion of free cash flow, and that'll de-accelerate to 1.3. But I don't think it's unheard of to say that we're going to be around probably 1.2 to 1.3, $1.4 billion of free cash flow, especially if you consider the fact that the China business is just so rapidly expanding. So if you take like a $1.2 billion of free cash flow, I mean, the stock-based compensation expense is relatively negligible. You're talking about, a 10% free cash flow yield, 11% free cash flow yield, and that's really cheap. If you look at the historical price-to-earnings ratio, you can see that it's about, we're at 14, 15 price-to-earnings, and the mean is 20 if you looked on over here. And obviously it's going to be inflated because you have some one-time EPS adjustments, but it looks like if you take these out, it's probably more in the high teens. So I mean, we're also below historical price-to-earnings ratio, so that's good. EPS is expected to increase in the teens, and the reason that it can increase in the teens, even though their margins and their revenue growth is expected to stay the same, is it because of the fact that they're doing these massive buybacks. So we're gonna have this is like 12% EPS growth, which is really solid. So in terms of the valuation of this, if you're gonna have if you're gonna have 1.2 to 1.4 plus billion dollars of free cash flow every year, and they buy back, even like $600 to $700 million of, I mean, it's going to be more than that. It's going to be like $1 billion of stock per year, but let's just divide it by 2 because they do have some debt. If they do buy back like $500 million at, say, like $40 per share, we're talking, the shares, we're talking them buying back like 12 million shares per year, which is really, really incredible. Considering the fact this business is worth like 11 billion, that's like buying back, 3.54% of their stock every single year, which is really, really solid. So you're getting, maybe 11 to 12% EPS growth from buybacks, and then you're getting maybe 2 to 3% of revenue growth on the top line. I think this might even be, conservative, right? Because look at their China business; it's growing 40%. I mean, obviously, it's going to de-accelerate soon, but I mean, that can raise the rest of the business up. They're doing a lot of events in Vegas, so if this goes to like mid-single digits, you're talking, 16-17% return, 16-17% return per year without multiple expansion. We're also like 14 PE, which is on the lower range of things. So if we have a small multiple expansion, that's like another 2% annualized probably. So you can get like maybe at a best end you might get like 18%, but that's like a 16 to 18% return per year, which is really solid, So yeah, this is why I really like MGM, and I just want to share with you guys. I have a position around like $38, maybe a little more, 38.50, something like that. So yeah, I mean, I'm just planning on holding this for a long time because of the buybacks. So I think this is a great business to invest in. Not financial advice.